On August 26th at noon Eastern Time, BMO hosted a discussion with industry experts to focus on what the latest developments mean for growth, investment, and business decisions in North America. The discussion explored the negotiating context between the U.S. and Canada, the implications for the USMCA Pact, as well as durable paths forward for an economic relationship that has rested on deep commercial ties and complementary strengths.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
Hello, and welcome to today's event titled Global Trade Outlook, the Canada-U.S. Tariffs Challenge. I'm Nadeem Hirji, Vice Chair, BMO Commercial Bank, North America. The Canada-U.S. relationship remains one of the most important and interconnected economic partnerships in the world. For generations, businesses on both sides of the border have benefited from integrated supply chains, strong investment flows, and a shared commitment to economic growth. Recent negotiations between Canada and the United States did not achieve a breakthrough, and we continue to see sectoral and targeted tariffs across what is otherwise one of the world's most open and successful trading relationships. As a result, many businesses are assessing what these developments may mean for their operations, their supply chains, growth plans, and their investment decisions. Today's discussion is intended to provide perspective on the current trade environment, what may lie ahead, and how businesses can position themselves in an evolving landscape. At BMO, we see conversations like this as an important part of how we support our clients, bringing together informed perspectives, practical insight, and timely discussion to help leaders make sense of a complex environment. Joining me today are experts in their respective fields. Firstly, Steve Verboel, former Chief Trade Negotiator for Canada and Principal with GT, who brings a wealth of experience with the various contours of the trade relationship between Canada and the U.S. Michael Gregory, Deputy Chief Economist at BMO, who will be sharing insights about the economic context for the changing trade relationships in North America. And finally, Francois Trahan, Chief Investment Strategist at BMO Capital Markets, who will speak about how financial markets are responding to the trade environment. So welcome to all of you. Steve, I'll start with you. What, in your view, led to the breakdown in the latest round of Canada-U.S. trade discussion? And as importantly, which areas of disagreement do you think, most important for businesses and investors to understand?
Well, thank you, Nadeem. It's a pleasure to be here this afternoon. I would say that the discussions broke down over a number of issues. It really was the cumulative effect of those various issues that made the deal unworkable for Canada. When President Trump postponed the U.S. 338 tariffs against Canada for 3 days, it was felt at that point that we could potentially be looking at the possibility of closing off these issues. Although I would say that levels of tariffs on autos, steel, and on aluminum were still not low enough from the perspective of Canadian stakeholders. So there were still some outstanding issues even then. But then as the two sides began to put down the framework of the deal on paper, a number of challenging details started to emerge, and that made things much more difficult. And we also saw some shifts in positions. So as I understand it, the key issues at that point in time were really around autos, and specifically the U.S. move to exclude medium and heavy duty trucks from tariff reductions on autos. That would have had a direct impact on production of those vehicles in Canada, both by GM and by Ford. So that was an issue that was going to be particularly problematic. Secondly, aluminum containing products were excluded from the reduction of tariffs in aluminum, and that was something we had not been expecting on our side and created a lot of difficulty. Thirdly, in both steel and aluminum, the U.S. was expecting that we would impose the same tariff level as the U.S. maintains against other trading partners. And with respect to both steel and aluminum, that would have meant breaching our obligations with respect to most of our trading partners, including those that we have free trade agreements with. Thirdly, we have the issue of, in the culture space, Canada would have had to remove requirements for streaming services to promote Canadian content, which would also have been very contentious within Canada. And then next, the U.S. would have had significant influence over trade agreements that Canada makes with other countries. And that, I think, would have been particularly difficult. And I'll just revert back to steel and aluminum in particular. The obligations did link to a lower tariff for Canada, but we would be required to impose the same kind of tariffs the U.S. imposes against others on steel and aluminum, which would have breached all of our trade agreements with any countries that we have them. And then finally, the U.S. would have had significant influence over trade agreements that we have with other countries, which would have been obviously problematic for Canada. And I just add an additional point that the U.S. also maintained the possibility of introducing further tariffs on products. They were not prepared to accept any constraints on their ability to add further tariffs going forward. So I think all of this generally would have locked Canada into a position where we would have had a very unbalanced trade relationship between Canada and the U.S. in the context of a bilateral relationship, implications for the trilateral relationship, including Mexico as well. And I think while Canada would be prepared to look at a Fortress North America kind of approach, if we go down that track, very difficult for Canada to accept a very unbalanced agreement in the U.S. favor. So I don't think Canada had any choice other than to reject what was on the table at that point in time.
Okay. So, Steve, just continuing on what you just said, because there was a lot there to unpack. How does all of these latest developments affect the USMCA review process? And what broader issues do you think that we haven't even thought about yet that might even emerge beyond what happened in this weekend's negotiations?
Well, yeah, no, that's the big question. I think that the discussions between Canada and the U.S. on the CUSMA review have now been put into some question. One of the outcomes expected out of the agreement between Canada and the U.S., if it had been achieved, was that there would be a commitment to a formal process under the CUSMA review to move those discussions along the same lines that Mexico and the U.S. have been pursuing in their bilateral discussions. But I think all of that is now in question, and I expect at some point we will get back to that kind of discussion, but I don't think it will happen anytime soon. And with respect to broader issues that could emerge, I think really we're looking at a fairly open field on that front, because I think the two countries are increasingly laying down markers that move them further apart, not closer together. So I think Canada is going to redouble its efforts towards diversification. I think that we could be seeing some action on procurement-related issues. We could see some action related to defense-related issues, energy issues, although I don't think the government will be prepared to use that as any kind of retaliation against the U.S. I think that's off the table. But Canada will aggressively pursue opportunities with other countries in relation to energy and critical minerals. So I think that we're really at a point where it's not going to be particularly easy to get back to the negotiating table, given the situation where we left that table, and the U.S. is there too. So obviously significant challenges ahead.
Steve, I don't have to tell you this as your expert negotiator, but sometimes negotiation is an art versus a science. And I would just love to hear from your perspective, what signals should business leaders and investors be looking for at this point that may indicate when or how negotiations may resume?
Well, yeah, no, I think that's a big question right now. There's clearly been some damage to the bilateral relationship between Canada and the U.S. It may take some time. In fact, it probably should take some time before we get onto a better track. But at some point, I think we're likely to see the development of some more constructive discussions beginning to happen, even if it's on unrelated issues. There will be some moves towards trying to establish a a more constructive kind of relationship. I think that the problem is, where are we going to start to have those discussions again? What is the starting point for those discussions? I don't think we can really pick up where we left off from, because that is very problematic. So I think that we really need to look at various different kinds of approaches to get us in a different space than we left that negotiation. So that may mean some kind of temporary ceasefire. That would probably be most desirable. Some kind of smaller climb down from where we are now, some positive steps towards revitalizing the relationship. But I really think it would not be a bad thing if a lot of these issues were pushed off to the CUSMA review rather than making an attempt to resolve them now, because we're now in a very difficult situation with the U.S. to try to move forward on these issues, given the positions that have been staked out. So that, I think, is a challenge.
Okay. Thank you, Steve. Appreciate the insights. Michael, just turning it to you. Recent data has shown that both Canada and U.S. economies are showing momentum and, frankly, proving very resilient through all this. So to what extent will this situation now and the newly imposed tariffs perhaps change that narrative?
Hi, Nadim. Well, you're absolutely right. The economies have been performing well, even though today we got some GDP numbers out of the U.S., 1.5% growth. The underlying growth in domestic demand is very strong because of two particular factors: the spending related to the build out of the AI infrastructure and the related wealth effect to that. And so the U.S. economy is rolling along. Canada, as we know, has not performed very well up to now. We will get the latest GDP numbers on Friday, and we're expecting to finally shake off the shackles of very weak economic performance. 3 of the last 4 quarters have actually had negatives in front of them. Now we think we'll be solidly in the 3% range come the current quarter. So now we're going to get hit with this sort of tit for tat, dollar for dollar trade tussle. Now, of course, when you think about dollar for dollar, a dollar in the U.S. economy doesn't matter as much as a dollar in the Canadian economy. To put that in perspective, U.S. exports to Canada range in the sort of the 1% range in terms of GDP. Exports to the U.S. for Canada are in the 16% range of GDP. Huge difference in those numbers. Keep in mind that a couple of years ago, that was around 20%. So the trade war has had an impact already. So Canada's going to feel the impact of the U.S. tariffs in terms of sales in the U.S. We think roughly about 0.5% of GDP. The U.S. unlikely to get any kind of be lost in the rounding in terms of GDP growth. Now, that's not just the end of the story in terms of the economic impact. We do know that, part of the reason for Canada's counter tariffs are to divert some spending to domestic production. So there'll be a benefit from that. And of course, the government has introduced measures to help support Canadian businesses and workers. They've added another $7.5 billion to the $25 billion tally that they've already done so far in this trade war. That said, there will be a slight extra headwind, though, the fact that some of this tariffs that will show up in higher prices for Canadians. The actual amount will be determined by how much substitution there is. We're roughly estimating around 0.2% at this stage, and that will be an erosion of purchasing power, not a good thing for growth. So overall, we're probably looking at Canadian growth down, 4 to 5 tenths, to the extent that these tariffs remain in place for a year. That, of course, is not a guarantee.
Okay, so just carrying forward what you just said there, again, we talked about the tariffs, U.S. tariffs are sector focused. Could you kind of run through the potential impacts on those sectors, but in Canada and or the U.S.? But also what is on people's minds is, it's easy to know there's impact on steel and impact on auto and parts manufacturing. But how do you track the spillover effects to the broader economy because of those sector impacts? How do investors and businesses think about that?
Clearly, there was a sectoral focus that's particularly on the U.S. side, looking at sectors in which Canada has a very large export exposure to the U.S., chemicals and plastics, electronics, forestry products, paper products, things like that. And those tariffs were focused on there. But they're also included in sort of a myriad of other sort of lesser known commodities, ranging from, hockey sticks to honey to actually horsehair, which I was surprised to know we actually export horsehair to the U.S. And on the other side, of course, Canada attempted to retaliate dollar for dollar, but not sector for sector, because realizing that Canada's impact on its counter tariffs were not going to have the same bang per buck on the national economy, they kind of focused on where Canada was a major customer for U.S. exports. And you're thinking of seafood, particularly shellfish, alcoholic beverages, and also perhaps catching up a little bit to the Section 232 tariffs that were previously put in place. So bringing up things like steel and aluminum, particularly on the steel side, iron and steel are as the sector in the U.S. that Canada levied the most tariffs on. And again, that will have an impact to the extent Canada is a major market for those products. So this is going to hurt sort of both sides of the border in terms of the economies. I do think, though, Canada's going to feel it worse, as I mentioned before. Something to keep in mind, too, is that even though from a U.S. national perspective, when you get down to the sectors, you get down to, you mentioned autos, you mentioned steel, the U.S. sectors will feel the impact of that. Just think about California wine producers, Kentucky bourbon producers, Maine shellfish producers. They will noticeably feel the impact. So the question is, we're feeling the impact. Certain sectors and states are feeling the impact. When do we see these numbers reveal themselves in terms of more broader impact on the economy? Well, I think we're going to have to wait for that. We'll be watching very closely the monthly employment figures on both sides of the border, monthly production figures. And I think those would be the areas where we would try to sort of suss out where exactly the impact on the economy is really beginning to spread. And it will spread. But the thing is, though, we do have, at least in Canada, mechanisms in place to try to mitigate some of the impact of that. It's going to be tough sledding. It's going to be hard. There's no question this is, even as the Prime Minister said, this is going to be a hard job. But, hopefully we can get through it.
Okay, Michael, thank you very much for those insights. I'd like to bring in Francois for a markets perspective at this point. So, Francois, will the latest trade developments have a more lasting impact on sector-specific investor sentiment or broader market trends?
Well, I think there's a lot of confusion, to be honest. The first thing to remember is that this is not just a one-off event. It is part of an ongoing trade realignment, and the story is still being written. So trying to separate, the initial reaction from the longer-term one, the initial reaction is often emotional at first in situations like these. And I think that's different than the longer-term economic realities. And I'll give you an example. I've seen this a few times in my career. After the financial crisis in New York, everybody thought the finance industry was dead, and therefore that New York City was going to turn into Detroit. And of course, that's not what happened. The technology sector took over, and the markets adapted, and the S&P and most of the indices are near all-time highs as we speak. And so longer term, I don't think what lies ahead is necessarily as it seems to consensus. There's a lot of folks out there that think that all we need is a new administration in 2 years and we can go back to the norm. And I don't know that that's necessarily what lies ahead. Friendly reminder that the Biden administration didn't remove the tariffs that were imposed on China during the first Trump administration. And we could also have an administration that doesn't have the ability to change tariff policy because of the fiscal situation in the U.S. And so I think it's more of a broader perspective than anything else rather than being so sector-centric. And as Michael says, who knows, this could all change in a matter of days, or at least this latest episode.
So, Francois, I know this is on top of everybody's minds as with the new tariffs. Like, what's the effect on, or possible effect on, monetary policy expectations in the US and Canada? And how are markets so far expressing views around this? And, I know when I'm talking to clients or investors, interest rates, foreign exchange, inflation, this is all top of mind right now.
Yeah, and I think, Nadeem, that's the easiest place to see the impact. So research on broad-based tariffs was settled 100 years ago. So at the margin, it is negative for economic activity, and it tends to be a positive for inflationary pressures. So that said, it's hard to isolate the impact of these tariffs on a real-time basis because there's always other things taking place. In the last week, we had the announcement from the Treasury of yield curve manipulation. This morning, you have the core PCE inflation data that's out. And so, there's other things that are having an impact on policy. I would say that it was in the US incrementally hawkish for Fed policy. And we did see the Fed fund futures shoot up on the announcement. Remember that the US has a 4.1% unemployment rate at a time when inflation is not back at the central bank's target. It's the opposite in Canada. I would say it's incrementally dovish. The unemployment rate in Canada is at 6.7%. And so it doesn't have to worry about inflation as much, but it has to worry, as Michael was pointing out, about economic activity. And so it was a boost to the futures in the US and a drag to the futures in Canada. And, where we saw the impact of that was on the US dollar, which shot up. And so I think context is very important, Nadeem, but at the margin, that's how I would read it.
So then whether you're in US or Canada, whether you're an investor or a business owner, leader, from what you just said, how should investors and business owners distinguish between could be short-term volatility versus longer-lasting implications for things like valuations and capital allocation?
Yeah, and that's the million-dollar question because there's a lot of uncertainty surrounding this, and we don't know, if this is a permanent state of things or part of a negotiation that will be behind us in 2 weeks. But I think beyond just this event, it's clear that the US is in the midst of a protectionist agenda, and protectionism at the margin is inflationary. So all other things equal, we're not putting anything in context. When you're thinking about this from an asset allocation perspective, in the US, I would say that this is a marginal negative for US equities and the S&P 500 in particular, because it is very much a growthy benchmark nowadays, has a lot of growth stocks, which are very sensitive to higher inflation. They have lofty PEs, and so don't respond well to higher inflation. It is a marginal negative for bonds for the same reason. And I think if there was ever, a time to consider gold, hard assets, tips, an inflation hedge as being a permanent or semi-permanent part of a portfolio, I would argue that this is it. And so that's how I would interpret the last week.
Okay, thank you very much, Francois, for your insights. So maybe one last question, and it might be an unfair question, but I'm gonna ask it anyways, and I'll ask it of all three of you. We've got thousands of business owners and investors on this call, both in US and Canada. So Steve, I'll start with you. And the question is, in your view, is this temporary situation in their minds, or is this a new normal that they should get used to and start adapting?
Well, I think obviously at this point in time, we're in a rocky period in the relationship between Canada and the US, and I think it's likely to get even rockier before it begins to improve. But I keep thinking back to some of the fundamentals that I think are important over time. First of all, the US business community is virtually unanimous in their support for continuation and extension of the USMCA. In their words, I think that the general public in the US thinks that USMCA is a positive for them overall. I think that they are also opposed to US tariff policy more broadly. So I think that puts us in a position where it's important to look at the U.S. tariff policy, and I think we can recognize that tariff policy is not really working. Manufacturing starts are down, manufacturing jobs are down. It's not really having the kinds of impacts that President Trump has been talking about. And I think all of that will have some influence over the dynamics in the discussion going forward. I'd also add that from any kind of perspective, there's no real value in alienating your best customer, your largest investor, and your largest trading partner, and doing that continually over time. There's no upside to that, really. So eventually, I think those kinds of pressures will come to bear. And I hope it's sooner rather than later.
Thanks, Steve. Michael, same question over to you.
Yeah, very quickly. I do think that, as Steve suggested, I agree with him that I think the situation is probably going to get a little rockier before it steadies. I tend in these kind of very volatile environments kind of lean back to the adage that you hope for the best and you plan for the worst. And right now, we do have another worst case to think about. I mean, the president has said, and he pre-announced the retaliatory tariffs for Canada's counter tariffs that were announced this week, effective January 1st, another round of Section 338's 50% on automobiles, parts, and any parts of steel products that are already at 50%. That's January 1st, by the way, conveniently past the midterm elections. But we do know that this thing could get worse. Now, maybe the prospect of that and the pressure we will get from U.S. industry. There's an article in the Wall Street Journal today that talked about that Detroit cares more about the Canadian trade deal than the rest of America does. I think that is very true. I'm hopeful that we start talking again. But I think as a business person, you got to sort of be planning, well, what is my worst case here?
Thank you. Francois, last word for you.
All right. Well, I think Michael points out that this is a fluid situation. Things could get worse, Michael. We could get back to the negotiating table and they could get better. I think Steve's comment that most business people in America support the free trade agreement is a big plus. I would say that, in the very long term, the human condition tends to prevail, and consumers view inflation as a variable tax rate. And so I think it was President Reagan that said that inflation was the most democratic force in society. I think if anything, what this latest episode has done is that it has exposed the narrative that other countries pay for tariffs. And so my sense is this will probably lead to a bigger conversation in the U.S. about tariffs and their efficacy.
Steve, Francois, Michael, thank you for your insights. For me, today's discussion highlights how complex these trade negotiations really are. To reach a sustainable agreement and continue to capitalize on the long-term fundamental strength of the Canada-U.S. economic relationship, it will be important to find our way to a win-win scenario. But in the interim, business leaders should continue to prioritize making calculated and informed decisions with a focus on long-term competitiveness and flexibility. So thank you all for watching and listening. A video replay, podcast episode, and recap article from today's event will be available on our website at commercial.bmo.com and at bmocm.com. You can also visit BMO's Cross-Border Perspectives Hub for timely insights on geopolitics, global trade, and more. Thank you again for joining us today, and have a great rest of your day. Thank you.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.